What's up, everyone? I'm Sean Herrero with Guaranteed Rate. I'm here with Mike Lyon from Unison Homebuyer, which is a unique program you can use that will match your down payment. The reason I have Mike here today is a lot of people refer to this as equity share, which it's not.
Correct.
They refer to it as down payment assistance, which it is.
It is, yet down payment assistance comes with typical ramifications around income restrictions, county and city restrictions, that kind of thing, and our program has none of that, so it's open for everyone.
And so with Unison, it's really based more on the property than the buyer, right? Because there's no income restrictions, there's none of the county restrictions, it's property-based.
It is. From our perspective, if you think about what we're doing, right, we're an investment partner.
Right.
And through our investment partnership program, we're concerned first and foremost, is this a property we want to invest in? And most are. Beyond that, we typically allow you, the lending professional, to handle the credit and income piece.
Got it. And so when we say you're an investor partner, you're investing with the home buyer.
We are.
That's the partnership.
We are. The partnership is really around two facets surrounding, number one, the purchase of the home, where we partner with the buyer at some level in the down payment. And then instead of earning an ROI, return on investment, like a bank does with payments and interest every month, we hope to earn a profit at some point into the future by sharing as a partner in the change in value of the property at some point into the future, whether it goes up or down at time of sale. So it's a true partnership, no payments, no interest to us ever.
So no payments, no interest, it's not a loan.
Right.
If the property decreases in value, you're a true partner, so you would participate in that loss. Mm-hmm. And if it increases, you're participating in the profit or the appreciation.
That's correct.
And I think what a lot of people get thrown off on when the initial reaction to this is, I don't want to give up my equity, right?
Yeah.
And they're not giving up equity.
Yeah, I mean, first of all, Sean, if you were to call me and say, hey, Mike, I've got this great program, Unison Homebuyer, it's equity sharing. You want to talk about it? I'd say, no, thank you.
Right.
No, thanks. Because I would presume out of the gate that someone is going to be sharing in all of my equity. So let me define the difference there for you. Number one, Unison does not share in any equity that's continued to be created by mortgage principal repayment, right, over time. Right. We don't share in that. Also, if the homeowner improves their property over time, and those home improvements create value at the time our agreement ends, as evidenced by an independent appraisal, we don't share in that either. So this is strictly, it's a very simple, dynamic program whereby we help a buyer buy the home they really want today, safely, because we don't have any debt associated with our agreement. And then as a partner, we share as a true partnership, whether the property goes up or down, and it's market movement only at time of sale into the future.
Right. So as an example of that, if I purchased a home for $800,000, I have a loan amount of $600,000. Over a few years, I pay the loan down to $500,000. So I've paid $100,000 down on my loan by way of principal reduction by my monthly payment. That $100,000 is all mine because it was my loan.
Correct.
I put in a pool, I redid the kitchen, so the property is going to appraise for more money as a result of that. That is all mine, my investment, my money.
Correct. The
market appreciated, and based on appraisal for market appreciation, this property increased by 10%. That's where we partner.
That's correct.
Perfect. Absolutely.
Absolutely. That's really a key component here relative to understanding what our program is and what it is not.
Yeah, and I think that's what's so hard for me. So I've referred to this program as Uncle Unison to get away from the equity share idea, because I think large gifts in our market are pretty common from family. Not everyone has that family member. So in that event, I try to describe Unison as being that uncle, that rich uncle none of us have, because it's not equity share. So what is the right term for it?
Well, I refer to it as an investment partnership, because that's really what it is, right? We're partnering in the down payment, and then we partner in the market movement of the property at some point into the future. So that's how I refer to it, as an investment partnership, because that's really what it is.
Got it. And what are the opportunities that you'll partner in, like percentage-wise? So if I was going to put 10% down, how does that piece of it work? Sure.
Well, I'll elaborate on that a little further if you don't mind. So,
yeah, please.
First of all, before we hit the market 5.5 years ago, getting almost 6 years now with the program, a buyer would come to you and say, Sean, tell me how much house I can buy.
Right.
You work up a debt solution for them and say, basically, here it is. And that's what they had to do. They either bought the house into those parameters or not.
Right.
we're now allowing a home buyer, potential home buyer, or purchaser to say, wait a minute, I'd like to understand all of my options. I'd like to buy a home the way I want to buy it. It's all about leverage, right?
Right.
So we will invest, first of all, basic parameters around our program from the investable side on the purchaser side. You must have 10%, okay? The buyer must have 10%. Half of that can be gift.
Okay.
So really you only have to have 5% of your own money. And then if you have your 10%, you can ask us to put anywhere from 10 to 20 right on top.
Okay.
Right?
Nice.
So we can take that buyer from a 10% down buyer to a 25% down buyer, even a 30% down buyer. If you think about what we're doing here, we're investing dollars at the time of purchase with no certainty of ROI, right? Because we don't know what's going to happen to housing. We don't know when the homeowner is going to choose to end our agreement up to 30 years into the future. So think about what we're doing, that the less dollars we invest, the less we have at risk, and the less we need to share, right? The more we invest, the more we have at risk, the more we need to share. So it's strictly a risk adjustment analysis around what our share is.
Got it. That's simple.
Yeah.
And with that, so going back to the qualifying. So again, going back to people saying, even colleagues of mine are, I don't know if I like the Unison program because you have to give up equity. It's like, well, that's not necessarily true. So if somebody qualified for a townhouse or a condo, right, that was kind of their upper limit. I look at those as kind of, like for me, when I was 19, I bought a condo, and then I sold that 2 years later, and I bought a townhouse, and I sold that 2 years later, and I bought a single family, and then the market fell apart, and things changed. But you don't necessarily have to do that stair step. I kind of look at Unison as giving someone the opportunity to get the house they want now. So if you qualify from a mortgage perspective for a townhouse at that price point, your equity or the money you would make on that investment in real estate is based on that property. If Unison allows you to bump to that single family, to the dream home that you were going to stair step up to, you're getting equity you wouldn't have had otherwise. You're not really giving anything up. Is that a fair assessment?
Yeah, I think it is. I think it's a matter of human nature is people don't want to give up what they perceive should be theirs, right? But last I checked, 0% of 0 is still 0, right? So that's number one. Number two, I think it's important to understand that we're providing value to an individual family, right? Our program, no program is for everyone.
Right.
The reality is that by stepping up, the purchaser / homeowner doesn't pay us back. The home does. Right. So in order to stair step, as you would put it, ostensibly, if you're able to buy a little higher at a little higher price point, you're theoretically buying in a little better area, maybe a better school district, extra bedroom. That property is going to appreciate more than the one that you could have purchased from a debt-only solution or with a debt-only solution, right? So therefore, your percentage of the increase is greater, and therefore that helps you pay us back relative to that dynamic. So it's definitely around, and you're to mention your colleagues and equity sharing and that kind of thing. I think it all boils down to, are we providing value to a purchaser, right? If they have 10% down and they're finding plenty of homes they love with 10% down at their maximum price point and they're comfortable with the payment, we're not really providing value, right? But any of those boxes go unchecked, we are.
You don't
potentially we are.
If you don't need a partner, don't use Unison.
Exactly.
If you don't need an investment partner, don't use Unison.
That's right.
But and for me, I think historically and traditionally, condos appreciate slower than single families. So I like using it for those situations. As I gave you an example when we came in. I have a client who qualifies for $1 million. He wants to buy higher. I recommended this program to him as an option, and then he can decide if he wants a partner or not. A minute ago, you said when we pay you back, when the buyer pays you back, they're not locked in for the 30-year term of the loan, right? When can a buyer, a homeowner, buy their partner out?
Sure. So you just said your loan officer at heart. You just said loan. So I just want to make sure.
Oh, did I really?
I just want to make sure it's not a loan, right? We're not lending here. But when can they pay us back? Absolutely. There's a lot of flexibility there. So very important to understand, we don't take any ownership of the property, right? We're not moving into the basement, right? Okay. So no ownership. Because of that, the homeowner drives that ship. So first of all, they can choose to keep our agreement in play for up to 30 years if they want. No payments or interest to us. Also, they can choose to buy us out of the agreement anytime after the third year. Okay. So can't do it in the first 3. This isn't short-term financing. We're not doing bridge lending here.
Right.
So after the 3rd year, if they want to end our agreement, they simply reach our way, let us know they want to do that. That triggers the ordering again of an independent appraisal. That appraised value is determines what is owed us.
Right.
If the property has stayed the same or gone down, they simply return our investment. They've had our money payment-free and interest-free for 3 years or 4 years or 5 years or whatever it was. If the property's gone up, we would treat it just like it was being sold.
Right.
Yeah.
And so that's all we have to do. So basically, after the 3 years passes, when they have the opportunity to buy out their partner, not pay off a loan, but buy out their partner, they could do that with cash on hand. If the equity has appreciated, we can do a cash out refinance to access that equity to buy Unison out. Through that refinance process, Unison is still only could we use that appraisal? Or does Unison do their own? So if we're doing
we would do a separate appraisal,
okay.
Right? Through an AMC and
got it. Okay. So that's basically it. So based on that appraised value is what you're paying back the initial investment. You're paying back Unison's percentage of the appreciation, and you're done.
Right. Exactly.
And if you didn't want to pay them, you're not obligated to do that within 3 years. You could run the whole term of the loan, and then when you sell, if you didn't sell for 30 years, paid off the loan at 30 years, then, hey, we're partners. I'd like to get my money back plus my percentage of
and in actuality, we're getting ready to initiate a change around the term.
Okay.
So mid-April or so, we're going to be moving from a 30-year term to a life estate. So there will no longer be a 30-year term.
That's awesome.
Homeowners will be able to stay on the property for as long as they live, as long as they wish to. No end date other than the passing of the homeowner.
That's awesome.
More flexibility is
great.
coming. So, but absolutely, you hit it spot on. It's all the homeowners call around when our agreements. We actually had one last week where the homeowner reached our way and wanted to consider a special termination, and appraisal was done. They paid for it, of course, because they're requesting it. Appraisal came back and they said, "Nah, you know what? We changed our mind. We just want to keep going." We said, "Fine, no problem."
Nice.
So a lot of flexibility. Yeah.
So I think people might wonder, why does Unison want to invest in real estate like this, and who are the investors? Where's the money coming from?
Yeah.
And why did you guys choose this route?
Yeah. Well, I get a lot of the comments in LOs and realtors ask me all the time, what kind of pushback do you get from consumers? And I don't get any, really. Right. But I do get this comment, Mike, it sounds too good to be true. What's the catch? And what they're thinking, of course, is the typical banking environment. A bank would never do this because they need an ROI next month.
Right.
So our investors, understanding who our investors are, is a big piece in that. So our investors are university endowment programs and pension funds worldwide. So those two institutional investors are very similar. They are looking for unique ways to balance their portfolio with real estate outside of a REIT environment, right? Mm-hmm. So one thing is for certain, since World War II, real estate has provided a great hedge against inflation. And that's what they're looking to do, is hedge inflation by balancing some of their portfolio with single-family residential real estate. So they recognize the risk, right? Because the reality is that if the homeowner ends up winning with appreciation, we win too. If the homeowner ends up losing with depreciation at time of sale, we lose too. Right. So our interests are very much aligned in that perspective.
And that's why, so because it's the university endowment and the pension funds, those are long-term, right? Retirement, long-term investments. And to your point, I always say that inflation is the biggest driver of appreciation. So if a buyer is buying a home and looking at the long-term, it's very hard to lose long-term, right? But if their job changes, they have to move, and they have to sell for unforeseen reasons, or they just want to, that's the only real risk, is if there's a dip, a short-term dip in value, that's the risk to any homeowner. Yeah, regardless if it's a house or not. Yeah,
exactly.
So that's there either way, but over the long term, it seems like a pretty safe bet, which is why I guess it makes sense for those organizations to want to invest with you.
Yeah, absolutely. No question about it. It's a very patient capital, right?
Yeah, right.
They're willing to take the risk for the added opportunity to get an inflation hedge vehicle over the long haul, and that's really the key component.
I love it. Is there anything I missed or anything else people should know?
Well, I just think that our program is really for those that want to have options around possibly being able to open up their inventory, right? And we do it safely because we don't have any debt associated. Those that are really uncomfortable with their monthly payment, regardless of whether you can tell them that they can make it or not,
right.
They're just not comfortable. Also, leverage is a big thing. We're starting to talk to a lot of people that have been saving and shooting for that magic, that golden egg of 20% because they've been told that that's really
right.
what you should do.
Right.
And then they get that 20 and they're really excited, but then it hits them. They're going to be putting all this money into one quasi-illiquid investment, right? And they find out about Unison and go, where have you guys been?
Yeah.
I don't need to do that anymore. I can put in 10, I can save half of all this money I put aside. What happens if life happens? What happens if the property needs work? What happens if I need to start saving for my kids' college education? All of those things. So I think it's all about value and leverage. And one of the other things that people don't really think about is that think about you're buying a house today and you're paying us back with deflating dollars into the future, right?
Right.
So there's really a lot of leverage play here for people as well. So I'd say you've covered it pretty well.
Awesome.
Yeah.
Thanks for the time. I appreciate it.
Absolutely.
If you guys have questions, reach out to me anytime. I can definitely, what I would do is kind of work out the loan details for you, figure out what options are best. Should you just do regular financing? Should you look at bringing on a partner like Unison? And then if you're interested in learning more with Unison, I would refer you over to Mike's team. But thank you so much, Mike.
My pleasure. Thanks, Sean.
All right.
Okay.